Bitcoin is a risk asset. Sure, it's beholden to the macro environment. We'll get into that. But it's also beholden to its own native 4-year cycle that investors seem to still trade around. So right on cue, October 6, 2025, we topped. It's been selling off ever since. A combination of the 4-year cycle, but also the macro backdrop have been a result of that. The 4-year cycle posits that 12 to 16 months following the all-time high, or following the cycle high rather, you see the bottom. And so that would put us at roughly October to early February at the very latest of next year. I tend to think it'll be a little bit earlier than that. And the macro backdrop sort of lines up with that too.
In a market obsessed with super cycles, infinite liquidity, and six-figure price targets, one of Bitcoin's oldest ghosts may have quietly returned. Not with a bang, but with a date. October 6, 2025, the exact day Joe Consorti believes marked the top of this cycle. And if he's right, then Bitcoin's journey through 2026 hasn't been a random correction. It has been following a script written more than a decade ago. What's fascinating is that Consorti wasn't supposed to arrive at this conclusion. He, like everyone else, previously argued that the 4-year cycle was effectively dead. The ETF changed Bitcoin, institutions changed Bitcoin, Wall Street changed Bitcoin, and yet, after watching price action, investor behavior, and the macro environment align in ways too precise to ignore, he changed his mind. Bitcoin may be the world's most transparent asset, but it remains deeply human. Markets move on psychology as much as fundamentals, and Consorti now believes millions of investors, from ETF holders to veteran Bitcoiners, are still trading around the same 4-year rhythm that has defined every cycle before it. The difference this time is that an oil shock, inflation expectations, and Federal Reserve policy are all converging on the very same window. In his latest discussion with Mark Moss, Consorti explains why Bitcoin may not be out of the woods just yet, why the true bottom could still be ahead of us, and why Q1 of 2027 could become one of the most important periods in crypto market history. If you enjoy macro analysis that goes beyond blind optimism and fear-driven headlines, make sure to like this video, subscribe, turn on post notifications, and let us know in the comments, do you think the 4-year cycle is alive and well, or has Bitcoin entered a completely new era? Here's Joe Consorti explaining why he believes Bitcoin's fate is now being determined by 3 converging forces, and why all roads appear to lead to the same destination.
I do think it's interesting that the bottom should be in somewhere around October, and when you look at the macro backdrop of what's happening at the Fed and the Treasury and so forth, it does seem to be lining back up with that. So what is your take on the macro backdrop in that timing?
Yeah, so it's very interesting. We almost have 3 conflating or converging rather factors here that point to this October/early Q1 timeframe for the Bitcoin bottom. And I'm right there with you. I ascribe very little weight to technical indicators or even on-chain levels because ultimately, markets don't know about calendars, like you mentioned. But that said, people do, right? So you have this investor psychology perspective, the 4-year cycle. Bidding, I expect to really ramp up into the fall, especially early Q1, as the 4-year cycle is expected to end. So that's thing number 1. Thing number 2, the other 2 major things. Number 1, the war in Iran. So on my channel for the last several months, I basically said, okay, the last major headwind for Bitcoin is the war of Iran and the oil shock, war in Iran and the oil shock that it's causing for global markets. And a lot of experts were saying, we all know we've cautioned against trusting the experts. But as far as geopolitics and oil were concerned, I trusted them on this one. And they basically were saying that if the Strait of Hormuz doesn't open or begin opening by mid-June, you're going to see an inflationary recession. And so I thought, all right, I'll take the mid-June timeframe. And then lo and behold, one day after the middle of June, exactly, the Strait of Hormuz opens. Like, look at that. Now, granted, only about 20% of the pre-war levels of oil supply have been flowing through the Strait. But basically what was slated to happen, should the Strait of Hormuz not have opened by mid-June, you already saw inflation tick up past 4%, 4.2% for the month of May for the very first time since 2023, late 2023, I think, late 2022, not sure. So as a result, that's just the early innings. That is like literally basically week number 1 of this oil shock. There's sort of a lagged impact of what happens when you shut off 20% of the world's oil supply and keep it that way for 4 months. It goes into not just diesel prices, not just gasoline prices, but the downstream prices of basically every good and service in the modern global economy. And so what we are on track for is a couple of months more of more elevated inflation prints, right? However, and this is the big however, because the Strait is now open, hopefully hopefully it stays that way. We just got news yesterday. Trump was at the summit and he said that he was going to bomb Iran. He said, we're going to bomb them tonight, which is the first time he has been as explicit as that, at least on camera. Ideally, it doesn't close the strait. So far, looking at the Bloomberg terminal, it looks like the tankers are still moving through, but at least beginning to open up the strait. That means that this impact, this lagged impact on oil prices that we have seen, chances are price inflation is going to normalize and then come down. Why do I say this so confidently? Well, crude oil has been dropping for about 3 weeks. So crude oil fell all the way back down to sub 70. It's now back above 70, unfortunately. But the reality is, if it takes about 4 months, right, for this price inflation to pass through, as we saw, it took from February to June for it to actually be reflected in the CPI report. And June is when the strait opens, right? 4 months after that is October, right? Which lines up with the end of the 4-year cycle. And so the macro backdrop, inflation coming back down to earth, also lines up with that date. This is further corroborated by the fact that inflation expectations, not from the New York Fed, but from another report last week, have actually fallen below 2% for the first time in like 2.5 years. So that's a major thing. And this leads into point number 3, which is about the Fed. So until yesterday, right, and ideally this remains the case, or until 2 weeks ago, rather, when the strait opened back up 2-3 weeks ago, the expectation on the table was that the Fed was going to hike interest rates. Kevin Warsh, first meeting, he came out, he did a bunch of jawboning. He said, you know, we're going to rein in price inflation. The Fed has been irresponsible for too long. But ultimately, like, you need to look at what they say and not what they do, right? And in the last 2.5 weeks, since the Strait of Hormuz has been opened, interest rate expectations have gone from 2.5 hikes until the end of the year, so between 2 and 3 hikes, analysts are expecting, to no hikes. And so now no hikes are on the table whatsoever. And so all of a sudden you go from the expectation of restrictive policy to the expectation of policy staying exactly where it is, at least for the time being. That could further be exacerbated if the strait opens even more than it already is. Inflation expectations drop further. You could see cuts before the end of the year. And that is sort of the tail risk for me is not one where you see rate hikes. It's one where you actually see rate cuts before the end of the year. I don't think that's on the table, but regardless, that is factor number 3 that is lining up in Bitcoin's corner. Previously, Bitcoin began selling off on the expectation of more rate hikes this year because the expectation going into Kevin Warsh being Fed chair was that he was going to cut rates regardless. But now that the oil backdrop with the Strait of Hormuz opening up and oil prices falling and inflation expectations for the year ahead are lining up, the expectation is now the Fed keeps rates on hold. So that's factor number 3. You have the Bitcoin native component, which is the 4-year cycle. You have the oil shock with crude oil prices coming back down to earth. And you have year ahead inflation expectations tamed to the point that the expectations for rate hikes are totally off the table. So those are the 3 things that are sort of lining up that all point to the exact same date, early Q4, October, November timeframe of this year.
Consorti's argument is compelling precisely because it doesn't rely on a single indicator. He's not calling bottoms based on RSI levels, moving averages, or on-chain metrics. He's looking at something much bigger, investor psychology, the lagging effects of an unprecedented oil shock, and a Federal Reserve that may soon find itself with fewer options than markets currently believe. But if macro conditions determine when Bitcoin finds its footing, the next question becomes even more important. What happens when policymakers realize they can no longer fight economic reality? According to Consorti, the conversation isn't just about rate cuts or inflation anymore. It's about preserving the entire monetary system that underpins global markets.
Think about it this way, like whoever Trump was going to elect, it was going to be someone who would play ball with the U.S. Treasury, because we are at a point now in our nation's history where the debt relative to the amount that we produce is, I mean, obviously it continues to increase year after year, but it is now officially the highest that it has been outside of wartime in history. And so we are at a point in our nation's history where rates have to at least be at an accommodative level for the U.S. Treasury to keep funding itself, right? And so that said, whoever he elected or whoever he nominated rather, was going to be someone who would play ball and do sort of the Treasury's bidding behind the scenes, talk independence on one side, but it's mostly feigning independence and then doing the administration's bidding on the other side. So Kevin Warsh is that guy, regardless of what he says. And so when you bring up the fact that they can't really do anything about this Iran oil shock driven inflation, it's very important to remember, right? Because he went out and he was talking about hiking rates, but I almost immediately knew that that was largely something out of his control. And so therefore, what he was saying was sort of just all talk, and he was never actually going to do what he was talking about. Because you have push inflation, you have pull inflation, right? Pull inflation driven by very low interest rates, a lot of consumer spending, a ton of money printing with newly printed money as a result of looser lending, and then obviously that drives prices up. And then you've got push inflation, where the input costs drive inflation. The Fed can control the price of money, but they can't control the price of oil. Lynn Alden said this. And so hiking rates would do nothing. It would do nothing to fix the inflation other than hurting consumers further. What other lever do you have to bring inflation down? Well, you just change the inflation measurement entirely. What you were referencing there was trimmed mean PCE, which is Kevin Warsh's proposed new way of measuring inflation. Now, I completely spaced on what this actually entails and its differences, and so I pulled them up while we were talking. Basically, what it does is it ranks all price changes in the economy, and then it dynamically excludes all of the edge cases. So all of the stuff that actually matters to you, right? All of the stuff that may be rising massively. Let's say gasoline prices, for example, rise 9% on month. Then guess what? They're going to be excluded from the inflation measurement. So price inflation may be rising massively, but it won't be reflected in the number that drives the Fed's decision making. It's this coalescing, and I love to see it, particularly around the 250th anniversary of this great country, this coalescing at the highest level around like American dynamism. So no longer are we sort of in this state where the Fed says, all right, inflation and unemployment, there are always going to be trade-offs, right? If inflation is high, the only way to kill it is by putting people out of work and vice versa. We're sort of moving into this regime where not only are the people in power trying to make it so that that's not the case, but they're also making it so that they're conducting policy in such a way where it's not just best for the American people, but it's also best for the status of the US dollar as its reserve currency, as a reserve currency for years and decades to come. And this is another thing that I think you and I really agree on. It's that like a lot of the dollar doomers, a lot of the people who are saying, oh, geez, guys, this is the year, right? Buy your gold bars and stack them under your floorboards. The US dollar is, you're going to have to shave them off to go buy gas and groceries, right? A lot of the US dollar doomers have been wrong for a very, very long time. But moving into an era where we have this increasingly fractured global economy and people are sort of looking for this neutral reserve asset to cling on to, obviously at the individual level, Bitcoin emerges as a tremendous asset to own. But the reality is the US dollar is so entrenched in the halls of global finance that it's really going to be difficult to unplug. And what I'm seeing with everything you just mentioned, Scott Bessent at the helm of the Treasury, Kevin Warsh at the helm of the Fed, both of them worked for Druck. They know exactly what they're doing. And both of them, in my mind, all of these moves that they're making are not just for the American people, but they're also to secure the place at the top of the fiat heap for the US dollar for years and decades to come.
If Joe Consorti is right, then the biggest mistake investors can make today isn't being bearish or bullish, it's being unprepared. Think about the implications for a moment. If Bitcoin's 4-year cycle remains intact, if inflation begins normalizing into late 2026, and if policymakers ultimately pivot back toward accommodation, then we're not approaching the end of Bitcoin's story. We're approaching the reset before its next chapter. And history suggests that the periods of maximum uncertainty have often created the greatest opportunities. That's especially important because the crypto market of 2027 won't look like the crypto market of 2021. The next cycle won't be driven exclusively by retail traders opening exchange accounts from their phones. It will likely be driven by institutional balance sheets, tokenized assets, stablecoin infrastructure, sovereign adoption, and a growing realization that digital assets have become a permanent part of the global financial system. By the time the headlines turn bullish again, much of the easy money may already have been made. That means preparation becomes the investment thesis. Building positions methodically, paying attention to macro trends, understanding liquidity cycles, following developments in Bitcoin, Ethereum, stablecoins, tokenization, and the infrastructure being built around them. Because markets don't reward people for knowing what happened yesterday. They reward people for correctly anticipating what happens next. And perhaps that's the most important takeaway from this entire discussion. Joe Consorti isn't telling people to panic. He's not telling them to expect financial collapse, nor is he promising that Bitcoin is about to go vertical tomorrow. He's simply reminding us that markets move in cycles, that macro still matters, and that the window between maximum fear and maximum opportunity is often much smaller than people realize. If the next 18 months unfold the way Consorti believes they will, then future investors may look back on this period the same way many look back on late 2018, early 2020, or late 2022. Not as a time to retreat, but as a time to prepare. If you enjoyed this analysis, don't forget to leave a like, subscribe to the channel, and turn on post notifications so you never miss another update. Share this video with someone who needs to hear a different perspective on where Bitcoin and the global economy may be headed next. And let us know in the comments, is Joe Consorti right about the 4-year cycle, or are we witnessing the birth of something entirely new? Thank you for watching, and we'll see you in the next one.